Hey there, curious minds. Ever hit send on your tax return and found yourself wondering about the professional who helped you navigate that maze?
Absolutely. I mean, beyond just crunching numbers, there's an entire framework of responsibility, intricate rules, and yeah, even some serious penalties that govern their world.
That sounds complex.
And it's a world built squarely on trust and precision.
Huh.
Today, our deep dive takes us into the detailed framework governing tax return preparers. We've got a stack of incredibly detailed sources
Mm.
that will help us uncover exactly who these professionals are, what their responsibilities entail, and the sometimes surprising consequences of falling short of those standards.
Okay, let's unpack this for you. Our mission is to transform a complex topic into crystal clear insights, making sure you grasp every crucial detail without getting bogged down. Let's get started.
So let's begin by clearly defining who exactly a tax return preparer is. Our sources tell us it's any person who prepares for compensation or employs someone else to prepare for compensation, any tax return or claim for refund required under the Internal Revenue Code or IRC.
Compensation being a key element there.
Exactly. And it's important to note that even preparing a substantial portion of a return counts as preparing the whole thing.
That's a broad definition. It sounds like a lot of people could unexpectedly fall under that umbrella.
It really is broad. Any tax professional holding an IRS Preparer Tax Identification Number, or PTIN, is authorized to prepare federal tax returns. This includes common categories like enrolled agents, certified public accountants, CPAs, attorneys,
Well, usual suspects.
right, and also those who participate in the annual filing season program, as well as other PTIN holders.
So if that's who is a preparer, who isn't, what about someone who just lends a hand in a very limited way?
Good question. The definition specifically excludes those who merely provide typing, reproducing, or other, mechanical
The
assistance.
data entry, basically.
Yeah. It also doesn't include someone preparing a return for their employer or for an officer or employee of that employer. And importantly, if you're preparing a return as a fiduciary, like a trustee or executor, that doesn't make you a tax return preparer in this context.
Ah, I see. So it's really about the depth of the work and whether compensation is involved. Can you give us an example that really illustrates how that substantial portion works in practice?
Certainly. Our sources give a great scenario. Imagine a small accounting firm that brings on interns. These interns review client data, enter information into the tax software, maybe even call clients for missing information.
Okay.
But crucially, they aren't allowed to offer any tax advice or make final decisions. Because managers prepare and sign the returns, the interns in this example are not considered tax return preparers.
Right, because they're not making the substantive judgments.
Exactly. This really helps illustrate that substantial portion requires more than just data entry. It involves substantive input and responsibility.
Makes sense.
Absolutely. So moving on from defining the role, it's also crucial to understand a preparer's representation rights before the IRS, as these vary significantly based on their credentials.
Okay. Tell us about those unlimited representation rights. Who has them, and what does that actually mean for a taxpayer?
Unlimited representation rights are held by enrolled agents, certified public accountants, CPAs, and attorneys. When we say unlimited, it means they can represent their clients on any matter before the IRS,
Any matter.
any matter. This covers a broad spectrum, including audits, issues related to payments or collections, and even appeals. For you, the taxpayer, this means they can truly be your advocate every step of the way, from preparation through any dispute.
That's comprehensive. And then there are those with limited representation rights. Who falls into that category?
That would be PTI owners who are classified as annual filing season program participants. Their authority is more restricted.
How so?
Generally, it only allows them to represent clients for returns they prepared and filed, and typically only during the examination phase.
Okay, so more specific. Now, what about PTIN holders who don't have professional credentials or AFSP participation? What can they do?
They are authorized only to prepare tax returns. That's it.
Just preparation.
Just preparation. And critically effective January 1st, 2016, these individuals generally have no authority to represent clients before the IRS. There's a tiny exception for returns they prepared and filed way back, on or before December 31st, 2015.
So for anything current, representation is off the table for them.
Pretty much. So for any new matters, their role is solely preparation. This really highlights why the IRS requires all paid preparers to register and obtain a PTIN. It's a fundamental step in regulating who can do what.
That distinction between representation rights is huge. It really impacts the kind of support a taxpayer can expect. Now let's get into another important one, the difference between a signing and a non-signing tax return preparer. Are these just labels, or do they really matter when it comes to accountability?
Oh, they absolutely matter, especially when it comes to responsibility and potential penalties. A signing tax return preparer is the individual with primary responsibility for the overall substantive accuracy of the return or claim.
The main person in charge.
Yes, usually the person who actually affixes their signature to the document.
Okay, so the one who puts their name on the dotted line. But a non-signing tax return preparer, that sounds a bit more nuanced. Can someone be a preparer for penalty purposes without ever seeing the final form?
They certainly can. A non-signing tax return preparer is any preparer who doesn't sign the return but still prepares all or a substantial portion of it,
Okay.
or offers advice, either written or oral, that leads to a position or entry that constitutes a substantial portion of the return.
Advice alone could do it.
Yes. To figure out what a substantial portion means, our sources explain we look at factors like the size and complexity of the item relative to the taxpayer's gross income. We also consider the size of the understatement attributable to that item compared to the taxpayer's overall reported tax liability.
So even if they don't physically touch the final form, their advice can make them liable. That's a fascinating nuance.
It is. Here's where it gets really interesting. Consider this scenario from our sources. An attorney, who is a PTIN holder, provides a CPA with a detailed spreadsheet for calculating the income to be reported on an estate's tax return.
Right.
This income calculation represents a substantial portion of the return. Even though the attorney doesn't prepare any other part of the return or sign it, they could still be considered a non-signing preparer for penalty purposes.
Wow. So just providing that key piece of calculation.
Exactly. This really underscores the broad scope of liability.
That example makes it incredibly clear how widespread the definition of preparer can be. Okay, before we dive into the specific penalties themselves, our sources lay out some key terms. Why do we need to understand these definitions first?
Understanding these definitions is absolutely crucial because they are the foundation for how and why penalties are assessed. They define the standards of conduct and the types of actions that can trigger IRS scrutiny. Essentially, these are the measuring sticks for preparer conduct.
Right, the rules of the game. So let's start with authority. What exactly is considered authority when we're talking about supporting a tax position?
Okay, authority. For determining whether there's substantial authority for a tax treatment, it includes things like the Internal Revenue Code itself, proposed and final regulations, revenue rulings, tax treaties, court cases.
The official stuff.
The official stuff. Even congressional intent reflected in committee reports. It also includes the Blue Book explanations from the Joint Committee on Taxation, private letter rulings, and IRS information or press releases.
What's not authority then?
What's not considered authority, interestingly, are things like treatises, legal periodicals, legal opinions, or opinions from other tax professionals.
So just because another expert agrees doesn't make it authority.
Precisely. The takeaway here is that tax positions aren't judged by expert consensus, but by specific, verifiable legal pronouncements. This keeps the standard objective and holds preparers to a very high bar of official interpretation.
That's a good distinction. So it's about official IRS or government pronouncements, not just general interpretations. What about disregard?
Disregard is defined as any careless, reckless, or intentional disregard of rules or regulations. It speaks directly to the preparer's mindset and intent, or lack thereof.
Okay, carelessness counts.
It can. And speaking of broad terms, person is defined very widely here. It means and includes an individual, a trust, an estate, a partnership, an association, a company, or a corporation. It covers just about any entity that could be involved.
That covers just about everyone.
Yeah.
Now, what's the difference between a listed transaction and a reportable transaction? They sound quite similar.
They are related, yeah. A listed transaction is a specific type of reportable transaction that the U.S. Treasury Department has explicitly identified as a tax avoidance transaction. So it's a subset.
A known avoidance scheme.
Right. A reportable transaction, in general, is any transaction for which information must be included with a return, because the Treasury has determined it has the potential for either tax avoidance or tax evasion.
And remind us of the difference there.
Sure. Tax avoidance is the legal use of tax laws to reduce your tax liability, while tax evasion is using illegal means to not pay taxes.
Got it. One is legal, the other is definitely not. And negligence.
Negligence includes failing to make a reasonable attempt to comply with internal revenue laws or to exercise ordinary and reasonable care in preparing a return. It also encompasses a taxpayer's failure to keep adequate records or properly substantiate items.
Okay. And these standards, like reasonable basis and substantial authority, how do they compare in terms of how strong a position needs to be?
Good question. The reasonable basis standard is described as a relatively high standard. It's significantly higher than a position that is merely not frivolous or not patently improper.
So better than just arguable.
Much better. It's not satisfied by just an arguable claim. However, if a return position is reasonably based on one or more of those authorities we just discussed, it will generally meet this standard, even if it doesn't quite meet the substantial authority standard. So it's a solid, defensible position.
So reasonable basis is good. What about substantial authority? Is that higher?
Yes, it's a higher bar. The substantial authority standard is an objective standard based on an analysis of the law applied to the relevant facts. It's less stringent than the more likely than not standard we'll get to in a moment.
Okay.
You meet this standard if the weight of authorities supporting your tax treatment is substantial in relation to the weight of authorities supporting the contrary treatment.
So the supporting evidence outweighs the opposing evidence substantially.
Correct. It's also met if the treatment is supported by controlling precedent of a U.S. Court of Appeals to which the taxpayer has a right of appeal. And crucially, because it's an objective standard, the taxpayer's personal belief about whether there's substantial authority is irrelevant.
That makes sense. It's about what the law and facts objectively show, not personal conviction. And finally, the more likely than not standard is at the highest bar.
Yes, that's the highest standard we're discussing here.
Yeah.
It's met when there's a greater than 50% likelihood that a tax position would be upheld by the courts. It is more stringent than the substantial authority standard.
Over 50% chance of winning in court.
Essentially, yes. So the IRS uses this tiered approach to measure confidence in a tax position, and your preparer's level of certainty dictates their risk exposure. It's not just about being right, but about demonstrating how confident you were in being right based on established legal precedents.
So what does this all mean for the everyday taxpayer? Why should they care about all these precise definitions?
Well, for you, the taxpayer, understanding these terms is vital because they define the level of certainty and support that should back any position taken on your return.
Right. It affects the quality of the advice.
Exactly. If your preparer takes a position that doesn't meet these standards, it can result in penalties not just for them, but potentially for you as well, depending on the circumstances. It's about ensuring the accuracy or reliability in the advice you receive and understanding the foundation of that reliability.
With those critical terms defined, let's delve into the actual penalties. First up are the tax return preparer compliance penalties under IRC Section 6694. What's the main purpose of these?
These penalties are specifically designed to ensure that tax return preparers comply with federal tax laws. They focus on the positions taken on the return itself. The first type is for an understatement due to an unreasonable position. That's Section 6694A.
So when is a position considered unreasonable in the IRS's eyes, specifically for a preparer?
A position is deemed unreasonable unless one of three conditions is met. First, if there's a reasonable basis for the position and it's disclosed on the return.
Disclosure is key there.
For that first condition, yes. Second, if there's substantial authority for the position, regardless of whether it's disclosed.
So substantial authority means no disclosure needed.
Correct, for avoiding this penalty. Or third, if it's related to a tax shelter or a reportable transaction, it's reasonable to believe that the position meets the higher, more likely than not standard.
Okay. And preparers can disclose using specific forms?
Yes, they can use forms like IRS Form 8275 to disclose positions that aren't contrary to regulations, or Form 8275-R for positions that are contrary to regulations.
And what's the financial hit for a preparer for this kind of unreasonable position?
The penalty is the greater of $1,000 or 50% of the income the preparer received for preparing that specific tax return or claim for refund.
Ouch. So it's tied to how much they earned.
Right. It can be imposed if the preparer took a position that understates tax liability, had no reasonable belief it would be sustainable on its merits, knew or should have known it was unreasonable, didn't disclose it properly, and the position lacked that reasonable basis.
That covers positions that don't meet the standard. But what about something more severe, like an understatement due to willful or reckless conduct? Where's that line between an honest mistake and something truly egregious?
That falls under IRC Section 6694B. A compensated preparer faces this more severe penalty if the understatement of the taxpayer's liability is due to the preparer's negligent or intentional disregard of rules and regulations.
Negligent or intentional disregard.
Yeah. Willful or reckless conduct means either a willful attempt to understate tax liability or a reckless or intentional disregard of tax rules and regulations, despite the preparer signing the return declaration stating it's accurate to the best of their knowledge.
So an honest mistake is one thing, but a willful disregard is another. Does the preparer have to dig into every single piece of information the client gives them to avoid this kind of penalty? What's the expectation for due diligence?
Well, not necessarily for every single piece. A preparer is generally not required to obtain supporting documentation unless they have reason to suspect the accuracy of the information provided by the taxpayer.
So if it looks fishy, they have to act.
Exactly. They must make reasonable inquiries if the information provided by the taxpayer appears incorrect or incomplete. So if something just doesn't add up, they have an obligation to ask questions and probe a bit.
And the penalty for this type of willful or reckless conduct sounds much steeper.
It is. The penalty is the greater of $5,000 or 75%, 75% of the income the preparer derived from that specific return or claim.
Wow, 75%.
Yeah. And if a penalty for an unreasonable position under 6694A was already assessed for the same action, this 6694B penalty will be reduced by that amount, but it's a significantly higher penalty because it implies a level of intent or severe negligence.
That's a critical distinction, separating mistakes from deliberate or reckless actions. Okay, beyond the compliance penalties we just discussed, there's a whole other category. Tax return preparer penalties for unethical behavior under IRC Section 6695. What's the purpose of these?
These penalties, they're specifically intended to protect the taxpayer from unethical conduct on the part of their preparer. They cover a range of administrative failures and improper actions, ensuring basic professional standards are met.
So, like, something as fundamental as not giving the client a copy of their own return, is that penalized?
Oh, yes, absolutely. A preparer is required to provide a copy of the tax return or refund claim to the taxpayer no later than when the completed return is given to them for signature or filing.
And if they don't?
Failure to do so results in a $60 penalty per failure, with a maximum of $30,000 per calendar year, unless it's due to reasonable cause and not willful neglect.
$60 might not sound like much, but it adds up.
It does, and you'll notice a common thread here. These penalties often target basic administrative failures things preparers must do, regardless of the tax outcome. It highlights the IRS's focus on foundational professionalism.
What about other basic requirements, like signing the return or providing their identification number? Are there penalties for those too?
Yes. If a preparer fails to sign the return when required, it's a $60 penalty per failure, also with that maximum of $30,000 per year. The same $60 penalty applies per failure up to that $30,000 annual max if they fail to furnish their identification number, their PTIN, on the return. It's all about transparency and accountability.
Makes sense. And record keeping. Do preparers have to hold on to copies of everything they prepare?
Yes, they do. Preparers are required to keep either a copy of the return or claim or a listing of the name and ID of each taxpayer for whom they prepared a return or claim for 3 years following the last day of the return period.
3 years. And the penalty for not doing that.
The penalty for failing to do so is, again, $60 per failure, with a maximum of $30,000 per return period. And for any person who employs tax return preparers, they must file an information return with the IRS by July 31st each year, detailing the names, IDs, and workplaces of their preparers. Failure there also incurs a $60 penalty per failure, up to $30,000 per return period.
This point really highlights the risk a preparer takes if they disregard fundamental rules. Now let's talk about a clear line preparers absolutely cannot cross.
Right.
What about handling a client's refund check?
This is a huge one, yeah. A definite bright line. Generally, any tax return preparer who endorses or otherwise negotiates an IRS refund check issued to a taxpayer, meaning it's made out to the client, not the preparer, shall pay a penalty of $600 for each such check.
$600 per check. That's steep.
It is. There's a very narrow exception for banks if the bank deposits the full amount directly into the taxpayer's account at that bank. But for individual preparers, it's a clear no-go. This rule protects clients from potential theft or abuse underscoring the trust aspect.
That's a significant penalty for a single check, clearly signaling the IRS's stance. What about due diligence related to specific credits, like the earned income credit? I know that one gets a lot of attention.
It does. The IRS imposes a $600 penalty for each failure to be diligent in determining a client's eligibility for or the amount of the Earned Income Credit, or EIC.
$600 per failure again. What does due diligence mean here?
Due diligence here involves specific requirements, using eligibility checklists, computation worksheets, making reasonable inquiries to the tax clicker to verify their information, and retaining all those records.
So they need a documented process.
Exactly. This penalty won't apply if the preparer can show their normal office procedures are reasonably designed and routinely followed to ensure due diligence compliance, and the failure was isolated and inadvertent. It's about having a robust system in place to prevent errors for this specific credit.
That covers a lot of ground in terms of administrative and ethical behavior. But there are still other significant tax return preparer penalties we need to cover that carry even heavier implications. Let's start with aiding and abetting.
Right. The penalty for aiding and abetting understatement of tax liability under IRC Section 6701 is very serious. And importantly, it applies to any person, not just tax return preparers.
Anyone, not just the preparer.
Anyone. The IRS actually has the burden of proof here to establish that someone is liable for this civil penalty, which is a higher bar for them than usual. It applies whether or not the understatement happened with the knowledge or consent of the person whose return is affected.
So the taxpayer might not even know.
Correct. And what's the penalty for aiding and abetting an understatement?
What is it?
It's a civil penalty of $1,000 for individuals and non-corporate entities and $10,000 for corporations.
Okay.
This applies if a person aids, assists, procures, or advises with respect to the preparation or presentation of any part of a return or other document, knows or has reason to know that such portion will be used for a material matter under the IRC, and knows that it would result in an understatement of tax liability for another person.
So knowing participation is key.
Yes, knowing participation in knowingly creating an inaccurate tax picture.
So it's about actively contributing to an understatement, knowing it will lead to that. What about the disclosure of tax return information? That sounds like a massive privacy and trust issue.
It is indeed a huge one. Under IRC Section 6713 and 7216, a tax return preparer who wrongfully discloses or uses information for any purpose other than preparing a tax return faces a civil penalty of $250 per disclosure or use, up to a maximum of $10,000 annually.
Okay, civil penalties. Anything else?
Yes. On top of that, it's considered a misdemeanor, punishable by up to a $1,000 fine and/or 1 year imprisonment, plus prosecution costs.
Wow, jail time potentially.
Potentially. And a client can also sue the preparer in a civil suit for damages. This highlights the sacred trust between a client and their preparer. Breaking that trust carries severe consequences, underscoring the vital importance of client confidentiality in this profession.
Are there any exceptions to this strict rule about disclosure? When can they share info?
Yes, there are specific, limited exceptions. Disclosures allowed by any provision of the IRC or pursuant to a court order are permitted. Also, allowable uses include preparing state and local tax returns or declarations of estimated tax for that same client. Certain disclosures and uses are also permitted by U.S. Treasury regulations for things like quality and peer reviews or administrative orders. Otherwise, confidential client information can only be disclosed if the client specifically consents to the release of that information.
Specific consent, not just general permission.
Exactly. That clear, specific consent is absolutely key.
That covers a lot about the direct penalties. But beyond the IRS, what other bodies oversee tax preparers and what kind of disciplinary actions can they impose? Who watches the watchers, so to speak?
That's a crucial part of the puzzle. If we connect this to the bigger picture, you see how these layers of oversight protect the public and the integrity of the financial system. Let's start with state boards of accountancy.
Right. CPAs are licensed by states, aren't they? What powers do these state boards actually have?
You're spot on. State boards of accountancy hold the sole power to license CPAs and, critically, to suspend or revoke a CPA's license. The licensure requirements passing the CPA exam, education, experience vary by state, but the power to grant or take away that license rests entirely with them.
So what kind of misconduct gets a CPA in trouble with their state board? Is it just about bad accounting?
No, it's broader than that. There are 3 broad categories. Misconduct while performing accounting services, like negligence or fraud, obviously, but also misconduct outside accounting services, such as intoxication or insanity affecting their ability to practice.
Really?
Yes. And the third category is criminal convictions, like a felony or even willful failure to file their own tax returns.
Okay, so if a board finds misconduct,
They typically hold a formal hearing where they must find it more likely than not that misconduct occurred. That's a lower standard than beyond a reasonable doubt in criminal cases.
yeah.
The CPA gets due process, notice, a hearing, and decisions are usually reviewable by courts.
And what can they actually do to a CPA? What are the penalties?
The penalties they can impose are significant. Suspension or outright revocation of the license to practice, monetary fines, public reprimand or censure, probation, or requiring additional continuing professional education courses, they can effectively end a CPA's career in that state.
Okay, so the state board holds the ultimate license power. Beyond the state boards, what about professional organizations like the AICPA? What's their role?
Right. The American Institute of Certified Public Accountants, AICPA, and its state CPA societies also play a significant role. They publish a code of professional conduct that applies to their members, and that code is often incorporated by state societies and even state boards. They also have something called the Joint Ethics Enforcement Program, or JEEP.
Deep.
Yeah, JEEP. It aims for a single investigation and action when a member belongs to multiple bodies, sharing information to promote uniformity in enforcement.
So if an AICPA member violates the code, can the AICPA revoke their CPA license?
This is a key distinction. The AICPA and state societies can sanction their members, but they cannot suspend or revoke a CPA's license. That power remains solely with the state board.
Got it. So what can they do?
They can expel or suspend a member from their professional organization. Sometimes this happens without a hearing if there's a conviction for serious crimes like felonies or willful failure to file taxes, or if a government authority has already suspended or revoked their license. Their joint trial board investigates and can expel members with a 2/3 vote, suspend them for up to 2 years, or impose lesser sanctions like required CPE.
That makes sense. The state governs the license, the professional body governs membership. What about the IRS itself? We talked about penalties, but what disciplinary actions can they take against preparers beyond fines?
Good point. The Internal Revenue Service has its own set of disciplinary tools. On the criminal side, as we touched on, fraudulent or false preparation of returns on material matters can be a felony. That carries penalties of up to 3 years imprisonment and broaders a $100,000 fine for individuals or $500,000 for corporations.
Serious criminal charges.
Yes. And on the civil side, beyond the penalties we discussed, the IRS can impose fines and, crucially, can prohibit an accountant or other preparer from practicing before the IRS.
Meaning they can't represent clients anymore.
Exactly. They can't represent clients, file returns electronically maybe, or correspond with the IRS on behalf of others. It effectively takes them out of the game for interacting with the IRS. And of course, taxpayers themselves can always file malpractice suits against preparers.
Okay. And finally, what about the Securities and Exchange Commission? Do they get involved with accountants? Seems like a different world.
They absolutely do, especially for accountants involved with publicly traded companies. The Securities and Exchange Commission, SEC, has significant disciplinary powers. They can impose civil penalties, including censure, suspension, or even permanently revoking an accountant's right to practice before the SEC.
Practice before the SEC. What does that entail?
That includes signing documents that are filed under the Securities Acts, like financial statements and annual reports. A permanent revocation by the SEC is a career ender for anyone working with public companies.
Permanent revocation sounds incredibly severe. What would trigger that from the SEC?
Reasons for such severe action include a lack of qualifications or integrity, unethical or unprofessional conduct, willful violation of federal securities laws, a felony or moral turpitude conviction, or even if their state CPA license has been suspended or revoked by another government authority.
So actions elsewhere can impact their standing with the SEC.
Definitely. The SEC can also impose hefty fines, up to $100,000 for individuals and $500,000 for firms, and issue cease and desist orders to prevent further violations. So if we connect this to the bigger picture, you see how these multiple layers of oversight by various bodies, state boards, professional organizations like the AICPA, the IRS, and the SEC all work together.
It's a complex web.
It is, all aimed at protecting the public and the integrity of the financial system.
What a comprehensive deep dive.
Yeah.
Now, from defining a tax preparer, understanding the nuanced distinctions in their rights and responsibilities, navigating that whole labyrinth of penalties from the IRS, and then finally seeing the broader regulatory landscape and who oversees the overseers, you're now armed with some serious knowledge.
Indeed. It really highlights the significant trust placed in these professionals and the robust systems in place, hopefully, to ensure compliance and ethical conduct. It's not just about getting your taxes done, it's about the integrity of the entire system that supports our financial interactions.
So as you reflect on this, consider this. In a world where even minor financial details can have major consequences, how much does truly understanding the behind-the-scenes accountability of professionals impact your confidence and choices when entrusting them with your financial life?
Something to definitely think about.
Thanks for joining us for this deep dive. Until next time, keep that curiosity alive.